Hey, Dr. Jeff Anzalone here, and today in this video, we're going to be breaking down the IRS's 2025 tax bracket changes, what they mean for doctors, dentists, other high-income earners, how these adjustments can impact your income. Now, I understand that taxes might not be the most exciting topic, but understanding these updates can really help you save more money and keep more of what you earn. Let's get going. All right, so here's the deal. The IRS recently adjusted the tax brackets for inflation to prevent people from being actually pushed into higher tax brackets just because of the rising wages. Now, for 2025, the brackets have actually increased by around 3%. Now, I know that may not sound like it's a lot, but it does make a difference over time by ensuring that more of your income stays in the lower tax brackets, even as inflation is actually pushing wages higher. So I want to give an example of, let's say you're a married doctor earning $350,000 a year. Now, after taking the standard deduction, so if you're a doctor, you're married, you're making $350K a year. Standard deduction this year is, if you're married, it's $30,000. If you're single, it's $50,000. Well, you're married, so you'll do 350 minus 30K. So that leaves you with 320,000. Let's say this doctor is an employee, so doesn't have any itemized deductions. All right. So I don't understand why they didn't teach us this in college, high school, college, especially dental or medical school or any type of professional school. Like, how is our money taxed? It's just boggling to me that I had to go to YouTube to learn it. Now I'm having to turn around to teach it to other people. Oh, well, at least you're getting it here. So let's go. So you think about, okay, you make $320,000 a year, you immediately think, okay, well, 40 or 50% of my income's taxed. Well, that's actually not how it works. Let me show you how. This is the breakdown of the new tax bracket changes from single and married. So again, this doctor is married. So for the first $23,850 of the $320,000 getting taxed, that's getting taxed at 10%. This comes out to be, and I'll write it over here and tally it up. And I've already done the math to save us time. The first $23,850 is taxed at 10%. So that would be $2,385. All right. The next amount, so if you take $96,950 and you subtract it from $23,850, that gives you $73,100. So the next 70 of this person's income, the next $73,100 is taxed at 12%. Okay. When you do the math, that gives you $8,772. How do I know this? Again, I did the calculations beforehand. All right. So then the next amount, which is in this range right here, which is actually the next $109,750, it's taxed at 22%. So when you take that and you do the math, that gives you $24,145. All right. And then the remaining $113,000 from this range right here, it's taxed at 24%. This adds up to $27,192. Now, if you go in and you add up all of this person's total federal, not state, but federal tax bill, it would be $62,494, roughly 62 grand. Again, not every dollar is taxed the same. Only the portion that falls into each subsequent tax bracket, that is taxed at that specific tax rate. This is what's called a progressive system, a progressive tax system. By doing this is going to help you understand exactly how your taxes are calculated each year and where your money's going. So here is where things are going to get interesting for, I talk about it all the time, the Kiyosaki, the cash flow quadrant. You have the employee here, you have the self-employed. This is what Kiyosaki talks about. Anything over here, you're trading time for money. More than likely, you're employee or self-employed. This is the poor side. This side over here, it's tax active income. This is active income. You're a doctor. You're an attorney. You're a nurse anesthetist. You're a pharmacist. You're an accountant. Whatever. You trade time for money. This is active income. This is how you're taxed. You're over here. Okay. Now, the goal is to get on the what he calls the rich side of the quadrant, which is the business owner and the investor. Typically, the income coming from over here, it's passive income or it's distribution income. It's taxed typically from long-term capital gains tax, which is a different tax bracket we're going to talk about. Real estate, stocks, anything like that held for over a year, long-term's capital gains. Okay. Real estate, I do a lot of real estate syndication, the distributions that come from all of my real estate investments, the real estate syndications in the investor column, passive income, they're taxed on this side. You get, if you have income coming from over here, which most people spend their entire careers focused on this income coming from active income, and that's why they get freaking hammered. But if you start focusing on getting income that's taxed over here, you get a special tax treatment. Okay. And let me explain. Okay. Check this out. I've got up here the 2025 tax bracket for long-term capital gains tax. All right. So let me explain this. So what this means is let's talk about if you're married. So if your taxable income is below 90, let's say your taxable income is anything below this, say it's $90,000. Guess what? You're going to pay 0% capital gains tax. If it's between 96,700 and 600,050, you're going to pay 15%, not what we talked about last time, the 25, the 32, the 35, the 37%, the higher tax. So you're taxed much lower. And then anything that you make, again, from long-term capital gains over 600,050, tax 20%. This is why it's so important to get into that investor column where your money is out there working for you, not you working for your money, which is what we spend most of our time, our careers doing. If you're like this gives you as an investor a huge advantage because, again, capital gains are taxed at a much lower rate than your ordinary income, your active income. Now, understanding this, understanding how taxes work, understanding these tax brackets isn't just about reducing your tax bill. It's about you going out and now for 2025, you can strategically plan, you can financially plan going forward. Again, doctor, dentist, high income earner, capital gains, tax. Think about tax efficient investments, passive income stream. All of these are powerful tools to build wealth without burning out by working more hours. As I talk about on my hundreds of videos that I've published so far on this channel, I don't want you going out there and I don't want you just going to work just for money. That's fine. We do have to start at that at some point, but I do want you to get to the point as you're working for money, then at the same time, you're getting that money to work for you. This is a perfect place to start through smart tax planning and investing. Okay. Again, 25 IRS changes, they may seem a little bit minor to you, but they can have a huge impact on how much you save. I want you to take full advantage, especially capital gains advantages, tax efficient investments, build wealth faster. I know that you have somebody out there in your mind that you say, you know what, this person should listen to this video. This person needs this information. Do me a favor, go right below this video, right below, hit the share button, send it to them. Make sure you subscribe to this channel. Why? Because that will tell YouTube that you are liking it. It will tell YouTube that it'll send me the information that you like it. So guess what? I'll keep making these videos. Now, I'll talk a lot about at the end about how most of my money that is taxed at long-term capital gains is coming from real estate syndications, group investment. You can go to your regular W-2 1099 job. You can treat patients, you can serve customers, whatever. You can make good money, but then you can take that excess money and invest it without burning out, without involving your time dealing with tenants and all of that. Real estate syndications. What is that? You don't know much about it? Good news, because I can help you with this video.